Good afternoon and good morning, depending on where you're signing in from. My name is Larissa Greene, and I'm with Advanta IRA. Thank you for joining us for this webinar on questions and answers. So we're going to be talking today about the most frequently asked questions we get at Advanta IRA. So there are a lot of questions that are going to be more about the rules, for example, who you can and can't transact with, but then we're also going to dive a little deeper into some of the tougher questions that we get on a regular basis, and we'll talk about deal structures and how they work within the rules. We also are going to be taking questions on this webinar, so if you have questions, make sure you get them typed into the question box. We do keep everybody muted just so that the webinar is nice and clean, but we're happy to answer your questions, and we'll take them throughout the webinar. Again, my name is Larissa. I'm with Advanta IRA, and I've been handling education and business development with Advanta for about almost 8 years now. I've been with the company almost 9. So prior to doing business development and education, I was actually working in the back office. So I helped with things like check coding for deposits, paying expenses on behalf of IRAs, helping clients with transactions. I also did new accounts and helped transfer money. So I'm very familiar with all aspects of the business, but really my absolute favorite thing to do for Advanta is to do networking and education. And so, of course, right now things have changed and things are a little different, but Reneika and I both would normally be out and about meeting investors, attending networking meetings. And we also do webinars and seminars live at our office. And we have a lot of interesting and fun things coming up. We have a lot of fun things planned for Advanta since we've sort of had to take a bigger step into the virtual world. So we'll talk about that in a little bit. How are you doing today, Reneika?
I'm doing pretty good, Larissa. Thank you so much for participating on today's webinar with me. I do want to say welcome to everyone. Thank you for taking the time to join us on today's webinar. Again, my name is Reneika Lightbourne. I'm a business development specialist here with Advanta. I'm actually in the Atlanta office. I'm a self-directed IRA investor myself, so I get to experience it from both sides of the table. I've been with Advanta as an employee since mid last year. To Larissa's point, we take great pride in actually networking and educating clients on self-directing as a whole. I'll say just a quick disclaimer before we get started. At Advanta, we don't give any clients any tax, legal, or investment advice. We also don't endorse any particular products. All of the information that we do provide you is just more so for educational purposes. So as always, you're encouraged to do your due diligence. Definitely consult with your professional team before making any investment. A few key points to take away from today's presentation. One is just knowing that any IRA or former employer plan can be qualified to be self-directed. And then the beauty is you get to choose the investment option that works best for you. And then lastly is actually understanding that all of the income that you generate from that investment must flow back into your IRA. And then all of the expenses associated would be paid by the IRA itself.
And so we're going to get into some examples on that in just a few minutes, but I wanted to give you a little bit of information about Advanta before we dive into the questions. So Advanta IRA has been in business for 17 plus years. We have over $1 billion under management. We have close to 7,000 clients. Our clients are nationwide and they're also worldwide. So if you have a US-based retirement account, you can self-directed and invest in the alternative assets that we're going to be talking about. We have 2 offices, as Reneika mentioned. We're in Atlanta, Georgia, and then I'm actually located in our Largo, Florida office. But really, location does not matter. Many of the clients that we work with are not only out of state, but far from us, and everything can just about be done over fax and email these days, of course. And there's the occasion where we need an original signature, but for the most part, everything is done digitally. So it makes for, a very quick investment if you need to do something where maybe you kind of do a deal over a cup of coffee and a handshake. We're here to help you with that. So it makes investing very easy. As I mentioned, we have a lot of exciting things coming up, because we've had to really sort of transition with everybody else into doing things like Zoom calls and virtual meetings. And so We've got some great things coming up. We're going to be doing a networking event through our Zoom account. So we're going to do one for our Atlanta office and one, excuse me, for our Largo office as well. And I'm really excited about that because this will be the first time that we're doing a meeting where you can come and talk about investments that you're working on with like-minded investors. So you can go to Advanta IRA/events and check out our calendar for those. We also have webinars every week, sometimes twice a week. So this week, Reneika and I are going to be answering your questions. And then on Thursday, we have a webinar with a mobile home investor, and he's going to be answering questions on mobile home investing. So you don't want to miss any of our upcoming events. They're going to be absolutely amazing. And if you register for anything, you will always get the recording. So there's an opportunity to watch it later in case you don't have the ability to sign on at the live during the live presentation.
Thank you, Larissa. So if self-directing, if self-directing is relatively new to you, or today's the first time you've heard about it, the main reason is most common IRAs are normally held by the banks and larger brokerage firms. And we know their business model is stock, bonds, and mutual funds. But in actuality, self-directing as a whole has been it's been allowed since the 70s. The IRS say that you can use those funds to really invest in a long list of opportunities, and we'll kind of highlight those as we go throughout the presentation. So why do people choose to self-direct? For you as an investor, you may choose to self-direct for any number or combination of reasons, one of which it can be a new source of capital for you. So if you have, say, funds sitting in an old 401k, you can look to move those funds over to be able to invest in your next project without, tapping into your personal savings or taking out that bank loan. Another reason why people choose to self-direct, you may be experiencing stock market fatigue. You're, unsure about being in the market. You're simply, tired of the ups and downs. A lot of investors look to self-directing because you have so many different options. It allows you to really diversify your portfolio and give you better control. And then the last reason is the tax benefits, the benefits of having those profits and dividends and, profits and returns from your account, from your investments flow back into that IRA account, tax-free or tax-deferred, just depending on the type of account that you have. So if you're, say, in a higher tax bracket, you can look to make that investment, whether it's in real estate or it's maybe a startup company, so you don't have to worry about those tax liabilities personally.
So we always like to kind of cover the different types of accounts that can be self-directed. And the reason for this is a lot of times I have people say to me, well, I can't self-direct my account because it's not a Roth IRA. And I'm not really sure where that comes from, but as a matter of fact, anything that ends in IRA can be self-directed. And then, of course, there's other plans that can be self-directed as well. So that's very important. The Roth is a very powerful account because it grows tax-free. However, if you have a tax-deferred account, you can self-direct that as well. So we have up here listed, of course, the more common types of accounts. Traditional IRAs are, of course, probably the most that I open here at Advanta over any other type of account. And probably the reason for that is just simply because people move old employer plans that are pre-tax accounts into traditional IRAs. We see Roth IRAs second, and then, of course, employer-based plans. So you have simple IRAs and SEP IRAs and solo 401ks. These are all great accounts if you're self-employed, and you actually are able to, as a sole proprietor or independent business owner without employees, hold these types of accounts. So sometimes people think, well, I don't have employees. My company is literally just made up of me, so I don't qualify. And the fact is, of course, you can have these types of accounts, and you have a lot of benefits for having those types of accounts as a sole proprietor, independent business owner. I also listed up here former employer plans. It's important to note the former, and the reason is because when you're currently employed and still participating in a plan, the administrator is going to, well, the trustee and the administrator are going to limit whether or not you can move funds from that plan. So you do have to have the ability to roll them into a traditional IRA in order to self-direct them. And so if you're still participating, you may not be able to do that. And I say may not because it's more than likely that you're not going to be able to, but we have seen exceptions to that rule. So if you're still participating, you're still employed, you want to reach out to somebody who can answer that question for you, or you, of course, can review your plan documents. We also have listed here health savings accounts and education savings accounts. And those types of plans, actually, the rules for self-directing them are exactly the same as retirement accounts. And so we can hold those as well, and they can be self-directed. And we're seeing more and more for health savings accounts. There's just a growing interest in health savings accounts. Whether or not you can contribute and have a health savings account is actually going to depend on your healthcare plan. So if you have a high deductible healthcare plan and it allows for you to make contributions to a health savings account, then you can certainly do that. And then, of course, self-direct it. So we're going to get to our questions now. And like I said, and I appreciate the questions coming into the chat box. I see those, and we'll get to those shortly. But we're going to start with the first question that I get on a regular basis here. Can I combine existing accounts? So I have multiple plans, you know, maybe an old employer plan, an IRA, a simple. How do I hold these plans? Can I combine them, or do they have to remain separate? And the answer to this is that the IRS actually is going to require that you hold any accounts that are taxed differently separate, but outside of that, they can be combined. So there's going to be, of course, some exceptions here, but for the most part, if you have for example, a traditional IRA, an old 401k, and maybe a SEP IRA, they can all be combined, and ultimately what type of account you combine them into is going to be very largely dependent on what you're looking to accomplish. So if you're still self-employed, you want to make larger contributions, then you may consider the solo 401k. If you're not self-employed, typically those funds are going to go into a traditional IRA. And then, of course, the exception being the Roth IRA, and because it's taxed differently, it's considered an after-tax account. It can't go into a traditional or a solo exactly, a solo 401k, but the reverse is true. So a traditional IRA can be moved to a Roth, but then, of course, you're going to have taxes in order to make that work. So just keep that in mind.
So another common question we typically get from more so married couples, they want to know if they can hold a joint account with their spouse. And by definition, an IRA is an individual retirement arrangement. So therefore, it's a single owner for each account. Later in today's presentation, we'll talk about partnering your IRAs with your spouse or other parties. But as it relates to an IRA, it's your own individual account. So typically when investors they're opening up a new account, they always ask, you know, how much do I have to move into my Advanta IRA account? And we let them know that there's no actual, you know, minimum amount that's required. They have the control to pretty much move as much or as little as they need to make the investment. So it's not end all be all. You have the control to move as much as you need to make that investment. Most investors, when they look to self-direct, they usually have an investment in mind. Like, say, for instance, they look to do a long-term hold with rental property, or they're investing in, say, a startup or syndication. But the key thing to remember is you have control. You can move back and forth as many times. You can set the dollar amount that's based on what you're looking to invest in. So when it comes to self-directing as a whole, really there's a universal list of options available to you as an investor. It's based on what you're most comfortable with. Say if real estate is your preferred investment strategy, and if you like single family homes, whether it's going to be a fix and flip project or it's going to be a rental that you're going to do for, say, short term or long term. Other investors like, say, you know, the lower maintenance with storage units and mobile home parks. You can also look to invest in multifamily units or pool funds with syndication projects where you invest in larger apartment complexes or commercial deals. Really, you get to choose the investment. If you're a paper investor, you can look to use those IRA funds to invest in, say, you know, notes and mortgages, tax lien, which is very popular among self-directed investors, Also, if you're a wholesaler, you can look to do assignments, option of contracts. Really, you have so many different options available to you. Some other alternative assets that you can use your IRA funds to invest in would be LLCs, whether it's a single member LLC or a multi-member LLC. You can look to invest in, say, farm animals or heavy equipment or private company stocks. I know oil and gas rights is a webinar that we just recently did. So if you haven't had a chance to, if you weren't able to attend it, definitely take a look. But you have a long list of options for you when it comes to self-directing.
Yeah, that's a great point, Reneika. And, a lot of times people will come to us with investments that we really haven't even considered. And it's more just that, of course, you're going to have some more typical investments, of course, like buy and hold real estate. But as Reneika mentioned, you also have things like cattle, racehorses, alpaca, where maybe these aren't common investments, but again, there's limits to the investments you can make, but there's only two assets or two asset classes there, and we'll talk about that in just a minute. And then outside of that, the sky's the limit. You're also going to have people you can't transact with, and we're going to talk about that as well. But again, outside of that, the sky is the limit. So very important to remember. Another question we get a lot are my self-directed investments guaranteed? And I think that's a great question, because when you move over, a lot of times people haven't heard of self-directed IRAs. This is a new concept to them. They're excited to put their money into an investment that they're choosing, but they don't understand really how it works. So a couple of things that I want to remind you of when you're self-directing your account. One, and Reneika mentioned, we're not giving any investment advice. Remember that disclaimer at the beginning of the webinar. We're not going to advise you as to whether or not this is a good investment. We don't do any due diligence for you. And so that also means that we're not guaranteeing any investment. So we're not going to sell an investment to you. We're not going to recommend it to you. And we're also not going to guarantee it. It's up to you as the account holder to make sure that you do your due diligence, that you're comfortable making the investment, and you're comfortable working with the investment provider that you're working with. It's also important that when you make the investment, you review it maybe with a professional that can help answer those questions. So if you're going to lend money, should it be in the form of a mortgage? Is there security to this mortgage? Are you comfortable with the interest rate? Did you look at the collateral? Do you feel comfortable with the collateral? Should you have to foreclose and take the property back? Or, of course, if it's a non-real estate asset, are you comfortable repossessing that collateral? So there's a lot of things that go into self-direction. Just a side note here too is that while the funds sit in cash with Advanta, it does have FDIC insurance. Each account holder is insured up to $250,000, and that's just simply pass-through insurance based on us holding a trust account. And then something that we do is make sure that the assets are properly vested in the name of the IRA account. So we're going to check, we're going to review the documents. Again, we're not doing due diligence here, but we're making sure that we see the IRA listed as the investor, regardless of whether it's real estate or private equity or you're buying gold and silver. It really doesn't matter, but what we're checking for is to make sure that it's properly vested in the name of the IRA, so that the investment itself remains tax deferred or tax free, depending on the type of account that you have. Another question we get a lot is, can I invest outside of my state or outside of the U.S.? And the answer is yes. So the IRS doesn't really have any rules prohibiting you from making those investments outside of the state that you live in or outside of the U.S., but something you should be aware of is that the country that you're investing in may have rules. And again, as the account holder, it's going to be up to you to make sure you understand and know those laws so that you're abiding by them, because we're really just taking your direction. The term self-direction really does apply here, where we're waiting for you to tell us how to make this investment, and then we'll simply help you get it done as the record keeper for that account. And I did see a question pop up that I wanted to cover real quick. I have a few, and I'm not ignoring them. We just are going to answer a lot of them as we go through the presentation, but I will make sure to go back to any that we don't answer. But somebody was asking about an inherited IRA. Can you self-direct those accounts? And the answer is yes. Of course, with the Secure Act that was recently passed, we're going to see some changes in inherited IRAs. But ultimately, yes, they can be self-directed. Excuse me. So you will be able to do that. You would simply move your inherited IRA via a transfer, and we're going to help you get that done. We're going to properly open the IRA as a beneficiary account, and then you'll be ready to self-direct those funds into any assets that are within the rules. So how do I know this is allowed? A lot of people are under the impression that this is new per IRS rules. And as a matter of fact, like Reneika said, it's been allowed since 1974. So in 1974, the ERISA Act was created, and it actually created IRAs. Although it does not govern IRAs, it was basically what brought them into existence. And so when IRAs were created, the IRS didn't say you can only invest in stocks, bonds, and mutual funds. Instead, again, they gave us a short list of things you can't invest in and a short list of people you can't invest or transact with. But outside of that, you were always able to do things like buy real estate. And so, although maybe, in the 80s and 90s, people didn't know about it as much as they do now, it was still allowed. And I love talking to people who have been investing in real estate a long time, and they say, well, I had an IRA with the bank, and since the bank couldn't find anything that said I couldn't buy real estate, they let me do it. Now, of course, those brokerage firms and banks aren't allowing it anymore because they realize that those assets might be hard to value, and they don't want to handle paying expenses and receiving income for those investments. And so that's sort of where we come in and fill the gap in the industry. But there are stories out there like that, and I love hearing those. So if you guys are curious, if you want to look up some of the information, there it is on the slide for you so that you can do some Googling and really dive deeper into those rules.
So just to kind of highlight the different, the few restrictions that the IRS does have in place that you must follow. Again, it's just a small list of things that you do have to be mindful of, and that's prohibited investments and prohibited transactions. So with prohibited investments, there's really only two investments that you cannot purchase in your IRA. That's life insurance and collectibles. Collectibles being anything like antique, art, wine, stamps, and coins. With coins, some coins are allowed, but that's solely based on the actual trading value of that metal. The other restriction is prohibited transactions, and that's who your IRA is not allowed to transact with. So meaning no personal benefit for any disqualified person. And your IRA is not allowed to transact with a disqualified person. So a disqualified person would be you, the IRA owner, your spouse, your parents and grandparents, so lineal ascendants, also your children, grandchildren, any spouses of your children or grandchildren, so lineal descendants. Also, your IRA is not allowed to transact with any business or entity that's owned or controlled by a disqualified person. And when I say transact, I just simply mean your IRA cannot be on the opposite side of the table from that disqualified person. Easiest way to think, buyer, seller, borrower, lender. So if you own a property personally, 123 Main Street, you can't sell that to your IRA, or you can't take money from your IRA and lend it to your spouse or your child or your parent.
We also get a lot of questions about partnering, and I think a few of these questions may also have popped up in the chat box. So we want to talk about partnering, and so there are some gray areas when it comes to partnering. However, for the most part, partnering is okay. And Reneika mentioned no transacting, and so no buying, selling, exchanging, leasing, providing services and goods. However, partnering would be putting money together at the outset of an investment. The investment has to be new to you as the IRA holder, and possibly new to the person you're partnering with if they're considered a disqualified party. So let's look at that a little deeper here. So if I partner, for example, if I partner my IRA with my husband's IRA, we can partner IRAs. There really isn't a gray area there. We're benefiting both accounts, but we're doing the investment at the outset, so it's new to both IRAs and new to us. And so that investment is going to be made, for example, real estate as tenants in common on the deed. Our partnership in that piece of real estate is going to be based on the amount each IRA brings to the closing table, no more and no less, especially when we're talking about disqualified persons. So for example, if it's 50-50, and again, it doesn't have to be, but if it's 50-50 and the purchase is $100,000, then my IRA has to have $50,000 and my husband's IRA has to have $50,000. once we establish that percentage of ownership, it can never be changed because we are disqualified persons. So my IRA, for example, can't buy out my husband's IRA. Going forward, the rent will be divided along that line and any expenses will be divided along that line. The record keeping for that type of partnership is very simple because Advanta handles that. So we're talking about 2 IRAs. Both IRA accounts are here at Advanta. When we receive a rent check, for example, for that rental property, when it is received and we pull it up in the system, we say, oh, Larissa and her husband own this property 50-50, and so that check will be divided along those lines. And same with any invoices we receive for expenses. Where you start to get into a gray area is when you're partnering outside of an IRA with somebody who might be considered disqualified, and that includes yourself. So although it's not expressly prohibited, you could partner personal funds with IRA funds. And something you just want to be aware of is that the IRS sort of put out this blanket rule where they say if there's a current benefit to a disqualified person, including the IRA holder, this could be something prohibited. So if I have $50,000 personal cash and $50,000 in my IRA, I could potentially partner those funds. But what we normally suggest then is talking to an attorney or CPA, somebody that can help you make sure that you're structuring that properly. But certainly, again, in that example, you would just simply be tenants in common on the deed. And the investment going forward would be based on that percentage of ownership, no more and no less. So again, something you could do, something that might potentially fall into a gray area when you're talking about individuals that may be considered disqualified.
Okay, so now we're going to transition and take a look at a couple case studies. This one is actually buying a rental property in your IRA. So we have Paul. He has funds in an old 401k. So he decided he's going to roll those funds over into his self-directed account because he wants to buy real estate in his IRA. He wants specifically to invest in rental property. Paul has $150,000 that he can kind of deploy and make his investments. Paul understands the rules when it comes to self-directing. He knows he has to go out there and find that property. Also, too, he knows he has control, so he gets to decide how much money he thinks he needs to put in to kind of get the property rent ready. In this case, he put in $20,000. Paul understands his local market, his rental market. He's done his due diligence, and he's going to get $1,500 per month from that property, which will actually flow back into his IRA. So the process for Paul to go ahead and get started, first and foremost, he's going to go ahead and open up his Advanta account. He's going to fund his account. Again, at Advanta, we don't have a list of investments for our clients to choose from, so it's Paul's responsibility to go out there and find that property, whether he's going to go door knocking or driving for dollars or searching the MLS or working with an agent. Ultimately, he finds the property. He then puts in an offer to purchase that property actually in the name of the IRA. With Paul, he's going to work with he has a dedicated account manager at Advanta, so he's going to work with that account manager to make sure that he completes and submits all of the additional purchase authorization forms. Ultimately, before any money leaves Paul's account, he has to read and approve and give his consent. Once he does, at Advanta, we'll go ahead and work with Paul's preferred closing agent or closing attorney that's going to handle the closing. We'll make sure all of the documents is properly titled and vested in the actual name of the IRA. And then Advanta, as the administrator, will sign those closing documents on behalf of the IRA, and then subsequently wire the $100,000 to complete the purchase. As record keeper, Advanta will receive and store all of the closing documents related to that investment. And then finally, if it's a rental property, the tenants will actually send the rental checks to Advanta to be deposited into Paul's account. And then we'll go ahead and pay those expenses associated with that account based on Paul's direction. So he can simply provide that invoice, talk to his account manager, or log into his online portal, and we'll get those bills paid out pretty quickly for him. So some things to consider when buying real estate in the IRA. The deed itself has to be titled within the name of the IRA. So it'll reflect as Advanta IRA FBO, which is for benefit of Paul's IRA number. That lets the IRS know that this property is actually owned by an IRA, which is tax sheltered. Again, Paul can, if there's any bills or anything associated or he has any inquiries, he can reach out directly to his account manager. He can, log into his online portal. The tenants, again, to recap, they'll send the checks to Advanta, and Advanta will deposit those funds into Paul's account.
So I had a question pop up about how you basically return money to the IRA and take a distribution. And the question is a little specific, so bear with me for just a second. I have a real estate IRA, a third of it in Roth, a third of it is personal funds, and a third of it is in traditional IRA. Tenants send rent back to the bank. Do I need to send it to the custodian before I take a portion of it personally? So in other words, into a distribution. And so what I think the question is referring to is an LLC. It sounds to me like this person has an LLC. The LLC is owned, or the members of this LLC are a Roth IRA, a traditional IRA, and also the person personally. And so the answer is yes, but you do have some more moving parts here because you have some personal funds in it as well. And so what I'd like to do is just simply ask you to reach out to us directly so that we can go over this in a little more detail, because when you have personal funds and traditional funds and Roth funds, what happens is you're going to kind of look at it as if, these are all completely separate individuals. And what would happen is if there was a dividend being paid out on this entity, then all parties would want to receive a dividend, not necessarily need to be distributed, but those funds do need to go back to the custodian. So again, there's a little bit of some moving parts here. And so if you could reach out to either Reneika or myself, and we'll go over that with you in more detail, kind of give you an idea of the process. But thank you so much for the question. So we had another question that is something Reneika and I answer all the time. So can I get deductions for an IRA-owned investment? And so the answer is really no. And the reason is because whether you're invested in real estate or stock, it's treated exactly the same. So it's very common for us to consider stock in an IRA, almost set it and forget it. We make an investment through a brokerage firm, and we leave it. Or maybe you trade stock, but the idea being that when there's gains or losses, you don't even think about them on your personal return. And so the truth is going to be the same with real estate or gold and silver bars or private equities, whatever it might be that you're invested in with your self-directed account. The asset itself is separate from you personally. And so you can't take any losses, for example, or any depreciation from IRA-owned real estate. So I hope that answers that question. The only exception, of course, is going to be if an IRA has financing. And so then now we're bringing in some more moving parts where the IRA is going to be subject to unrelated debt finance income tax. And when that happens, now because we're exposing the IRA to a tax, we also have the opportunity for the IRA, again, not personally, but for the IRA to take some deductions. And we'll give you an example of that in just a few minutes. So for the next slide here, can I get a loan to purchase property? And so that's really sort of addressing that UDFI or UBIT tax. And I know I had a question in the chat box about this, and so I'll address that in just a minute. But so can you get a loan? And the answer is yes. And I always think that people are always surprised by this because they figure, well, if they don't have the cash in their IRA, then the investment won't get done. But there's a couple different strategies, including, of course, partnering that we already talked about. But you can also get financing. And there's some things that you need to be aware of if you're considering financing for your IRA. So an IRA can get financing, but the loan is to itself, to the IRA and not to the IRA holder. So that means that it has to be non-recourse. And again, it exposes the IRA to this unrelated debt finance income tax. So that's going to bring us into the next case study where we're going to kind of cover an example of that, so that you understand how the tax works. And this example is going to be on the very simple side, just because UDFI is not simple in its own rules and calculations. So I made it a simple example, but there would normally be some deductions taken in this example as well. So using financing to buy real estate. So Mike's real estate deal, he has an old 401k. He wants to buy a rental property, and he knows it's going to need some work, so he's going to take that into consideration. And he has a certain amount of money, but he would really like to save some money in his IRA for the repair work that he knows is going to need to be done. So he's going to do a non-recourse loan, again, to the IRA. And a lot of times people will say, well, a non-recourse loan, is that even something that you could possibly get? And the answer is yes. I mean, of course, it can be private money, again, as long as it's non-recourse, seller financing, or there's some national lenders and some local lenders that will do non-recourse as well. And they really look at the property. And so you might have to put more down. You might pay a little higher interest rate. And a lot of times they won't allow you to do something where it's going to be a fix and flip. They want something buy and hold where they can do a rental analysis and they know you're going to be able to cover the mortgage payments through the IRA, because remember, the loan is to the IRA. So the payments are made by the IRA for that loan, monthly or quarterly or whatever it might be. And so I gave you an example here at the second half of the slide. $90,000 at 6% for 30 years. The monthly payment will be $540. So annually, he's got $6,500 that he is going to owe the bank. So again, Mike cannot personally guarantee the loan or extend his personal credit. And so non-recourse, meaning the bank can only foreclose and take the property back. The loan is directly to the IRA, so the IRA repays it. And so again, just a few of the things that we already went over is you're going to see a higher percentage required down. Typically, you're going to pay a little bit more for the interest. But, you know, typically it's actually not too bad. Now, I will tell you this, though. We talk to people, and Reneika, maybe you can weigh in on this. I talk to probably 50% of people interested in buying real estate about using financing to purchase real estate, but we only have about 1% of people actually follow through. Do you feel like that's what you're seeing as well, Reneika?
Yeah, it's usually a smaller percentage of people actually going through and doing, you know, the non-recourse loan. They tend to more so end up partnering or looking at other opportunities. But UDFI and non-recourse loan does occasionally come up in our initial conversations, but for the most part, they look to more so partner or invest in other opportunities.
Right. And I think you hear tax and you hear non-recourse, and these moving parts are a little intimidating, but we definitely have clients who use a non-recourse loan. They pay their tax and they're happy with it because it gives you more buying power. So if you have $50,000 in an IRA, now you may be able to buy, you know, a $90,000 property or more. And so, you know, there's the advantage to it. Normally what I tell people is run through the calculations, see what you'll be paying in the tax. And if it makes sense for you to do so, and it doesn't hurt to have a CPA that is familiar with UDFI or UBIT as well, and they can help you understand how that works. The IRA is going to file an additional form called 990T in order to pay that tax. And you have the advantage of course, every year you're paying down the loan, you're going to owe less and less, excuse me, in that tax. And then once, of course, the loan is paid off, you're not going to have that tax burden for the IRA any longer. And so here's the calculation page for you to see sort of how it works. And with a non-recourse loan, the IRS says that you can do this. They're going to allow you to do it. However, because you're artificially inflating the value of your IRA account, the income related to that debt is going to be taxable. And again, you normally would also get deductions here, but I didn't add the deductions into the calculation just for simplicity. So in other words, if you borrow 50%, then 50% of the annual income is going to be taxable. So here you see side by side the comparison for having debt versus not having debt. And so total monthly income is going to be $2,000 per month. And so annually you have $24,000 on both sides. Your loan payments, so remember that the IRA is responsible for making those loan payments, is $6,500 a year. Your expenses, we have $6,000 on both sides, and then net prior to UDFI. So you can see the difference already in those calculations. Now you have the $6,900 would be subject to the UDFI, and so UDFI tax calculated at 28%. Yes, it is high. Is around $1,900. And so at the end of the day, the bottom line, you can see the difference is almost 50%. However, in this scenario, and again, sort of on the side of having financing when you're making a purchase, in this example, Mike would not have had enough money to make that purchase and therefore probably would not have had the amount of income he did based on his buying power. So something to consider. And again, although we talk about it more frequently, we only see about 1% of clients actually go forward and use financing in order to make a purchase. I did have somebody ask me a question about UDFI and UBIT and whether or not it applies to a solo 401k. So that's a great question. UDFI, when it relates to financing on real estate, does not apply to a solo 401k. So it applies to an IRA. So if I make this purchase that we talked about for Mike's IRA in an IRA, he is going to be subject to UDFI. If he has and is eligible for a solo 401k, he is not subject to UDFI. However, when we talk about UDFI and UBIT, and sometimes those are interchangeable, we're talking about debt financing for real estate. If your IRA is exposed or your 401k is exposed to business activity, UBIT would still apply. So I hope that answers your question. So if there's some business activity in your 401k, UBIT would still apply. And a clarification on business activity is a tough one because it just depends on what you're invested in and how income is being returned to the 401k. So it's probably a good question for your CPA. But if the investment is not considered a 100% passive, and again, I know that doesn't really help with the definition, but then you may be subject to UBIT in the 401k.
Okay, so now we're going to take a look at the last case study, which is checkbook control. Sometimes you might hear it referred to as an LLC IRA. I know we had a lot of questions in the chat box, in the question box about checkbook control. So checkbook control just more so gives you greater control over your retirement funds. This is where the actual IRA is the 100% owner of an LLC, and then you get to act as manager, or you can have another person act as manager of that LLC. As the manager, you have the ability to write a check, pay a bill, sign a contract on behalf of that LLC. Definitely, if you're looking to use the LLC feature, consult with your professional team like a CPA or an attorney to assist you with setting that up. Okay, so the actual steps for setting up and using checkbook control. In this scenario, we have Joe. First and foremost, he's going to go through the process of opening up and funding his Advanta account so that he can do the application online. It's a pretty quick process. We'll be here to guide him through it if you have questions. And then Joe gets to decide how is he going to fund his account. Is he going to roll funds over from a former employer plan, or is he going to transfer funds from an existing IRA at a brokerage firm? And then afterwards, we can get his account open pretty quickly, typically within that 24 to 48 business hour time frame. The next step for Joe would then be to form his LLC. So he has complete autonomy where he can decide which state he wants to open up that LLC in. He gets to decide, what he wants to name the LLC. With the articles of incorporation, instead of listing himself as the owner, Joe's going to go ahead and list himself as the manager, or again, he can have another person listed as the manager. At Advanta, the main thing that we'll need is the actual operating agreement. That's something that Joe can draft himself or work with his CPA or attorney to assist with drafting the operating agreement, which is going to show that the IRA is the actual 100% owner, the IRA is the member of that LLC. And of course, the name and convention would reflect as Advanta IRA, FBO, which is for benefit of, Joe Smith's IRA, his account number 800-123. That lets the IRS know that when this LLC make an investment, whether it's to buy real estate or again, invest in any other alternative asset, that is actually tax sheltered. The next step, Advanta will sign that operating agreement on behalf of the IRA. Ultimately, Joe has to read and approve. He has to give his consent before before any money leaves his account. Once he does, we'll go ahead and issue a check to fund the actual, issue a check from Joe's IRA to fund the LLC. Now Joe has that check, he can go to his preferred banking institution. He'll then open up a bank account, deposit those funds, and now he has checkbook control. So with checkbook control, he can go and enter into a contract to buy that real estate deal, buy that property that's down the street. And then of course, as manager, he has the authority to sign all of the related closing document. And then moving forward, if his investment is, say, a rental property, the tenants will actually send the rental checks back to Joe, and he'll be able to deposit those funds into the LLC's bank account. It's also Joe's responsibility, and I know we had a question about this, it's Joe's responsibility to make sure that he's actually paying all of the expenses associated with that rental property. So if he has, say, property taxes, or he has insurance he got to pay, or he has to pay a contractor, he would simply pay it using that LLC's bank account. And then, of course, he can, rinse and repeat the cash that's sitting in that account. He can move on to his next investment. Just to kind of recap some of the takeaways from today's presentation, again, knowing that any IRA that you have, any former employer plan that you have, you can roll over and self-direct. And then you have autonomy. You choose the investment that works best for you. And then again, knowing that all of the income you generate from that investment will flow back into your IRA if the IRA is the only party involved in the deal. And then, of course, all of the expenses paid by the actual IRA itself.
So I'm going to address some of the questions that we maybe missed as we were going through the presentation. I know there was a lot of questions on checkbook control, and Reneika covered that. But maybe, Reneika, you could talk just quickly about how the LLC works in liability, and a lot of this is kind of fall under you really need to talk to your CPA or attorney, but I'm sure Reneika, just as I do, we sort of deal with that question a lot.
Yes, thank you. So definitely consult with your attorney if you have any legal questions. When it comes to the actual LLC itself, it's a disregarded entity. It is tax sheltered because it's owned by the IRA. When setting up, definitely before considering using LLC, make sure you understand what the process is if you have legal questions. But the actual LLC is owned by the IRA, which kind of gives you some tax benefits in terms of it being tax sheltered. For liability concern, again, I would say confer with your attorney on any other legal questions.
And that's a really good point, because we don't set up the LLC for you. It's going to be between you and your professional team to get that LLC set up, and so then I would look to those professionals to help you with those questions as well. I had a question about whether or not in scenario 1 or case study 1 it would be different with checkbook control. I think we did get that question answered with that case study, but let me know if you have something you want us to expand on. So is there anything when a self-directed IRA buys and sells, the income is subject to tax? And again, I think we covered that, really talking about the UDFI and the UBIT. For the most part, those investments that we see being made in a self-directed account are going to be passive. And so when you're making an investment into a long-term rental, for example, or you're lending money to somebody in the form of a note mortgage, these investments are passive. And so you're typically not going to have any taxes due for those investments. So again, we talked about business activity. If you're flipping properties, usually we tell you to talk to your CPA or your accountant and find out what they feel might be considered the business of flipping properties versus simply, making 1 or 2 investments passively and, finding a buyer for those investments. And so we really can't give you advice on that, but just keep that in mind. At some point, if you're considered a dealer of some sort, or you're doing the business of whatever investment it might be, then you might have taxes owed. And again, you want to definitely talk to your CPA about that and your specific circumstances. Make sure you get your questions typed into the chat box, and I'm just reviewing the questions now. I want to remind everybody that we have a lot of events going on a couple times a week. We have the next one coming up with our partner, Alex Perney. He's going to be talking to Adrian Smood about investing in mobile homes. I think it's going to be a great webinar. That's on Thursday. If you go to Advanta IRA /events, or excuse me, AdvantaIRA.com/events, you're going to find the information to register for all of those as well. If you're in the Atlanta or Tampa Bay area, again, we're going to have a networking event where you can talk about investment strategies you're using with the group network, ask questions, share your haves and wants. I think it's going to be a great opportunity. We're going to try to do those once a month, so go ahead and check it out. If you're not in those areas, we invite you to join us anyway. I know those sometimes those types of events are going to be specific to the area and advantageous to people living in those areas. So I think we really answered all of those questions. I see one more. I own a wholesale company. I'd like to use self-directed IRAs for transactional funding. Yes, that can be good. That could be fine. Something you could possibly do, something you want to keep in mind, though, is that you can't use your IRA funds for transactions you're involved in. And so if you're working with another wholesaler, somebody in the business that you want to do transactional funding with, you can certainly do that with an IRA. If you have business partners that normally supply you with that transactional funding and you'd like them to be able to use their IRAs, that is something you can do. But again, you want to be careful about transacting with yourself in those scenarios. Reneika, was there anything you wanted to add?
No, I'm just responding to some of the questions in the chat box. I'm sorry.
Oh, no, that's okay.
Thank you all for taking the time to partake in today's webinar. Again, if you have questions, feel free to reach out to either Larissa or myself personally. We'll definitely get you a copy of this recording. And also, too, if you want to, talk about your exact scenario, feel free to reach out to us at 800-425-0653 or visit our website at advantaira.com.
Thank you, guys, and we hope you join us for the next one. Thanks, Reneika.
Thank you, Larissa.